Hello again, everybody. Welcome to another edition of Under the Macroscope, Skybound Capital's weekly podcast. And wonderful to have back with us the Chief Strategist for the group, Jabir Sardharwalla, based in the London office of Skybound Capital. Jabir, one of your most popular podcast appearances in recent times was your very excellent assessment of the UK property market, both residential and commercial. And we thought it was timely to have an update on that, see how things are trending, and see average UK house prices, how those are behaving since we last spoke, and particularly the discrepancy between how those prices are behaving in and around central London and throughout the rest of the UK.
Yeah, so in the past, what's happened is London has always led the way. But we've seen a noticeable change now. So for instance, if you take just some of the stats that I'm going to throw at you, the average UK house price, and I appreciate it is an average, it takes the entire country and we have different types of houses here. But the average is 266,000 as of the end of June. But then when you start to drill down further, the disparity is quite interesting. So for instance, England leads the way, where the average price is 284,000. But then it drops after that to Wales at 195,000, Scotland 174,000, and Northern Ireland at 153,000. So I guess it begs the question, what's driving this? And this goes back to that podcast where we were looking at migration stats in and out of London on a both domestic and international basis. And what you find there, quick recap, is that domestic emigration, i.e. domestic movement of people from London to the other parts of the UK, is running at about 350,000 a year. I mean, that's a staggering sum. And people coming into London from the rest of the UK is about 255,000 a year. And then you have the international component, where there, interestingly, there's no shortage of foreigners wanting to come and live here. Nearly 193,000 a year, whereas only 115,000 are actually emigrating overseas. So I'm going to make it so that gives you a net sum of just under 17,000 leaving London. However, just think about the impact on the property stock, because I'm going to make an assumption here that people who move internationally will probably be renting out their homes. Because if you think about the rents that they collect, which I'll come on to in a second, that goes a long way into paying for overseas accommodation. And I don't think they would want to be without a home back in the UK. They always want a base to come back to, just in case. On the domestic side, obviously you're going to have a similar situation, but I don't think to the same extent. I think there people are possibly thinking, I need a change. Fed up with the London way of life, too expensive. It's difficult to make things meet. Let's sell the property and buy something somewhere else. And for those prices that I read out earlier, you can see that they're going to be paying a lot less. And if you take mortgages, for instance, the average mortgage in London is £359,000. So that gives you a loan to value of 70%. So if you're selling, here's another interesting stat. So within England, the average home price in London is £510,000. Okay, that's huge. London is now growing at the slowest pace, but still that's a very large figure. So they can sell their home, free up about 150,000, and use part of that to put down a hefty deposit. Let's say 20%, because that will then get you the best mortgages, and buy another property for vastly less and still have cash freed up. So this is a demonstration of the wealth transmission mechanism in play. And the reason other parts of the UK, particularly England, and especially the North, are starting to rise quickly in prices is because of, I think, two things. One is that, obviously COVID's had an impact. people have thought, well, if this happens again, I want somewhere where I'm more comfortable. But the second thing is that since the victory of Boris Johnson and the Conservatives, there is a very big levelling up play that's going on across the country. And the North is benefiting enormously from that. So, you look at the mortgage rates, they're very attractive. You can get a fixed rate, 2-year fixed rate for 1.99%. You can get a 5-year fixed rate for 2.25%. So, if you want to sort of secure your cash flow, you can do it. I think this is a very big part of what's going on. And I think this is going to drive trends going forward now.
But with the move out of London by domestics, if we can call them that, there's still no marked effect on London prices. So is it a fair assumption that international people wanting to come into London are sustaining those price levels in and around central London?
Yeah, definitely. And also don't forget people coming in from the domestic community as well. I wouldn't be surprised if those coming into London are perhaps of a younger age range, because that has always traditionally been the trend. So, the young ones obviously see London as the place to be. The not so young ones who have been there, done it, seen it, are thinking now it's time for a quieter lifestyle. And there's a really interesting chart that I came across which looks at the mortgage cost as a percentage of your disposable income. And it's fascinating because at present, London accounts for about 45% of the disposable pay packet. Okay. If you then go further out, the first place that people have gone to is the Southeast, because it was much cheaper back then. Today, that's 40% of the pay packet. And then the Southwest is 34%. So it's declining, but obviously these places are quite high now. Yeah. Where they used to be is if you look at up north right now, because the east of England is about 28%. East Midlands is 27%. This is all as a percentage of your pay packet. West Midlands, 29%. And when you start getting to Northern Ireland and Scotland, you're hitting 19, 20%. But rents are still incredibly high. So let's compare London. You got 45% for mortgages. Rents are nearly 90% of your disposable income. That's for one individual. So obviously, for the most part, they're going to share. That's why you suddenly have so many people living in one place. But if you're a couple, then let's say your share is half that. Your rental share still brings you back to what it would cost if you had a mortgage. So why wouldn't you want to own a property? Well, that's the problem, because we're not building enough. That's the problem. And private renters today take up 20% of the housing stock in the market. And the age range is skewed to the 50 and above. There simply isn't enough.
Yeah. And I suppose it's impossible to consider residential and commercial mutually exclusive. I mean, we've spoken about this need to get people to come back to work. And you've got some interesting views around this, because we've seen some excellent record rentals being achieved in central London coming out of COVID. So if businesses are going to want people to come back to work, they've got to make environments attractive. But then that's also going to fuel the residential market around those hubs.
Absolutely right. I would say there are two factors that are going to really drive commercial property, i.e. the return of people back to working out of a building. The first is if the average London commuter is spending give or take an hour in commuting. So if you're going to make it, if you're going to try and encourage them to come back to an office, then make it worth their while. It's got to be a nice social place to be. That's the first point. The second is really around the energy efficiency thing. It's ESG. There are some very stringent rules that have come into play in terms of what is constituted as energy efficient. So for instance, right now, 10% of commercial property falls in the least energy efficient categories. So these would be F and G. And from next year, the new ruling state that it will be an offence to lease buildings with an EPC, that's an energy performance certificate, that is below E. So this is very stringent. So you are seeing new investments waiting on the sidelines. This is data from some of the leading estate firms. But the number of transactions haven't been that many so far, but those that have been done have been very close to pre-pandemic prices. So you've got a huge amount of activity going on, big ESG driver here. You're trying to make energy the key thing, because something like the 35% of emissions are coming from buildings, and 77% of buildings are in the private sector, the residential sector. So there are some very big challenges here. I mean, the cost, perhaps the easiest way to fix the energy issue is if everybody moved towards a new type of boiler. But the thing is, that's going to put you back £10,000 to £12,000. And who can afford that? So I think the commercial market has made big inroads there. You're seeing yields coming down. And the drivers are city offices, which is good news. London Transport has reported that passenger volumes are now back to roughly, this is an average figure, back to 50% of pre-pandemic. But actually, if you look at the busy lines, I had a pretty tough journey home yesterday, and it's more than 50%, that's for sure. It's easily around 70, if not 80%. So the key lines are really getting back there quickly, and that's a very encouraging sign. The other thing to bear in mind also is retail warehouses are seeing more uptake, and that's evident in the yields, which are coming down even more. So I think the challenge that commercial faces is no different to the high street. If you want to encourage people to go back and shop there, then you've got to make it attractive for them. You've got to make it like a day out, a family day out. That's where shopping centres are seriously challenged. And in the same way, offices have to think about making an ambient workspace. And no more issues with air conditioning. It's got to be good.
Yeah. And it's been impossible to chat to you in recent months, really, and since last year, without raising the topic of inflation. So perhaps to finish off, you could just give us your view on how the property market dynamics are playing into that broader theme.
Yeah, so in fact, based on a recent Savills report, the equivalent prime yields now are around 5% up. Now, in the UK, inflation, it depends which measure you take, although both are in the same direction. The CPI, the Consumer Price Index, is coming in at around 3.2, 3.3. Saw a very big jump last month. But we also have another measure here, which is being debated, possibly being faded out, and that's the RPI, the Retail Price Index. And that's well over 4. It's around 4.5. So in terms of, if you like, real yields, the CPI, you're still making around 1.5. In terms of the RPI, which only really Brits would look at, there you're close to neutral. Now, for the most part, and this really comes down to how well inflation can be controlled, property has mechanisms in the legal arrangements whereby they can be ramped up in line with inflation. But at the end of the day, if inflation jumps too far, you're going to hit a stage where you're talking about a big slowdown. So there is a limit to how far property can cope. But certainly for now, it's potentially an asset class to look at. Just last thought on inflation, because in Germany, the Greens are now the kingmaker. So what do? Do they suddenly say, yes, we buy into the Nord Stream 2? In which case people will say, well, hold on, what kind of a Green Party are you? On the other hand, if they delay, Europe's going to go through a lot more pain. So there is a real dilemma here, but I think actually the problem can be fixed in terms of supply. The question is how we get about it politically.
Well, it sounds like another podcast for another time, and certainly a very influential macro factor to keep a close eye on. Jabir, as always, wonderful to get your views on Under the Macroscope. You can download the podcast on Apple, Spotify, or the Google podcast platform for Android, and all the past editions of the podcast are available at www.skyboundcapital.com. Until next time on Under the Macroscope, have a great week.